Okay, update on the broad markets here, the S&P 500 and QQQ. We'll also look at IWM if we have time. And so starting with the QQQ, this is really important. So we have made a new low on the weekly. So we made a new low today, which is causing a new low on the weekly below that weekly swing low that was in place on week 20. So this is week 23. We just made that low today. So this was your potential weekly cycle low here, right? This week you had bullish follow through at one point, and then you failed, and you got this red week reversal sign. Then you got the bearish follow through, and now we're getting more bearish follow through this week. We've made a slight undercut low of this low here, um, and so now at week 23, we're getting into the timing band that you want to be looking higher for that next swing low. So like for instance, this was a swing low, right? Like but this was week 16, right? Some people were pretty bullish. You could even see at one point this candle was nice bright red bright green. So we had the bullish follow through we were looking for, and then we just failed and then got bearish follow through the following week, and now we find ourselves again below, well below this low, and now we're below this other swing low that we made on week 20. And so now if we were able to recover this week, let's say after the Fed meeting, it's possible that we're printing our weekly cycle low right now on week 23. We'll have to see, obviously, how the price action develops. It would make sense given it is the week that the Fed is going to announce their rate cut. That said, it's entirely possible that we could get a weekly cycle low that then starts another weekly cycle that is actually bearish and has a top that's early. So if we look at the daily chart, we can see that this is the low that we made today, which is causing that weekly swing low, or excuse me, that weekly or that the new low on the weekly. This is day 34 of the daily cycle. The top was day 7. We know this daily cycle was already a fail because the previous daily cycle, we're already below the previous daily cycle low, which is below the daily cycle before that. So it's another way of thinking about, we're clearly in a downtrend. We're making lower lows and lower highs, right, through the whole way. And so now at day 34, we're getting later in the daily cycle. We had this swing low on day 22, possible daily cycle low. We even had a close above the 10-day moving average. Looked potentially promising. Now we're getting this rollover showing you this definitely was not a daily cycle low. And so we're now getting later in the daily cycle. And so again, the same, like we should expect potentially this daily cycle low to also be the weekly cycle low. So it's really just a question of, how low do we go? What kind of undercut do we get? I mean, would it be crazy for us to find ourselves down to 297? I don't think so. That seems to me like a minimum. That would take us back to the low we saw last March, right? Right around this time. Almost kind of rewinds the clock a whole year. The other thing that's important here is that the Qs have made a new low, but the S&P has not, right? Notice this is where we closed on the S&P today. Also day 34. This was also day 22, a potential daily cycle low. But the S&P is on, so S&P here on the left, Qs on the right, is actually holding up much better than the Qs. And if you think about S&P topped out on June 4th, whereas the Qs actually topped out on November 22nd, right? So they've been declining for much longer. We made this little double top sort of thing here. Then we went low, lower, high, lower, low, lower, high, lower, low, lower, high. And so now you imagine we get some more downside here, right? We made this small undercut. We maybe get some more downside, let's say going into the Fed meeting. I have to imagine this brings the S&P down. So you have to imagine you get that low below, call it 411 on SPY. It seems unlikely that Qs is not going to drag down the S&P, but I'd say the broader thing to be aware of is we're closer to a daily cycle low in terms of time and just really downside, right? That doesn't mean the next cycle is going to be bullish. It just means we should expect some kind of bounce that lasts at least a few days, right? Something tradable, maybe even 5 or 6 trading days at the worst case scenario. We don't. It's hard to say if it's going to be a bearish or bullish cycle, but you should expect some bounce soon. That said, you've had cycles that went 54 days, obviously. So this being day 34, we could certainly continue to sort of decline from here. And then you have, the S&P. Again, same thing, day 34, except we haven't made a new low. And then you look at the weekly chart, it's week 23, just like the Qs, but we have not made a low below that week 20, swing low. So my expectation is we do go below this low, even if, marginally. It just seems unlikely that the Qs don't drag down the S&P, but we'll have to see. And going over to IWM, I think is also, IWM is somewhat unique. It's on like a very different kind of count in some ways. So IWM has a swing low back on week 31, right? And that looks, right now is a potential ICL, yet we haven't made much progress above that swing low, right? We got this little almost follow through, and then we failed really right at the 10-week moving average. So I would expect, similar to how the Qs are going to drag down the S&P, I would expect just general market moving into an ICL. We're going to see a low below this 190 area, and maybe come down and revisit this gap from the vaccine down at like in the low, the high 160s, I should say. And finally, I'll also just kind of circle back really quickly to the monthly charts. Just good to take perspective. This is definitely a very recognizable yearly cycle low. I mean, look at this decline. This was a yearly cycle low in 2018. This was your COVID crash. This is a very, in terms of time, again, we topped out in November, late November, and then we had 4 red months. You had this doji of a month, December, then big downside January, follow through February, and look how you left these wicks, right? Like, people get excited about wicks because, again, a wick is always a rally on a lower time frame, but this wick is just one of those lower highs we're seeing on the daily and the weekly chart, essentially. So it's something that it's good to remember that, to not get sort of lured in. I could easily see we continue moving lower, maybe kiss this level here around 297, and then we start to bounce. We get a wick like this on this March candle, we start to recover. So, certainly there's more money to be made on the short side, because I think there is still more downside. But I'd say the bigger opportunity is playing that bounce, even if it's not if it's not a sustained bounce for weeks or months. You can still get a pretty furious squeeze, and a pretty nice 10-15% gain in a relatively short period of time. And so this is the S&P on the monthly, same kind of thing, very credible yearly cycle low. This was your COVID crash. Obviously, this went much lower than anyone expected and then kind of snapped back. This is your other YCL. This is your other YCL. So as YCLs go, relatively severe in terms of the decline itself, the amount of time it lasted. I mean, think about the fact that we've now been falling for an entire quarter, essentially. I mean, we'll see how March sort of finishes out. And so, again, I think there is going to be a furious rally on the other side of this. It's a question of how long that rally lasts. But if you catch the sort of early part of it, set your stops in the right places, a lot of money to be made.